I think the best way to think of the money supply, and people can understand, it's the fuel for the economy. So if you're putting a lot of fuel injector in the engine and rev it up, you're going to do what? The first thing that happens is that asset prices go up. Then the next thing that happens, economic activity revs up. And then the next thing that happens is that inflation kicks in. And then if you take the fuel out, start contracting things, and don't give the engine enough fuel, asset prices go down. Well, asset prices haven't gone down yet in the United States, and economic activity hasn't really slowed yet. And the inflation has, by the way. So the idea, change the money supply, and ultimately you're going to, with a lag, get these changes in asset prices, economic activity, and inflation. And in fact, as I look at the record around the world, I've not been able to find one significant inflation that's ever occurred without a significant prior increase in the money supply. And what do I mean by significant? I'm talking about just 4% inflation for over 2 years. If you have 4% inflation for over 2 years, I think that's significant. And if I use that measure, I find no cases where the money supply hasn't increased significantly prior to the piercing of the 4% number and the duration for over 2 years. So that's really the general idea. Now, people aren't looking at that. The U.S., by the way, right now, to get up to speed, the money supply is growing at 2.6% per year, and to hit the Fed's inflation target of 2%, that money supply should be growing about 6% per year. And the money supply is actually lower. The stock of money in the U.S. economy is less now than it was in July of 2022. So we've had a contraction actually in the money supply, and it's growing very slowly right now. And this signals to me two things. One is that the inflation rate will continue to go down. It did pop up a little bit the last reading. It went from 2.4% per year to 2.6%, but it'll go down, and I think go down below the 2% Fed target next year. Inflation, I think, will go actually below the target. And the reason for that, we've had this contraction in the money supply for a couple of years, and the inflation lags behind that change in the money supply by usually 12 to 24 months. So it's kind of, as I say, baked in the cake. I know this because the money supply has been contracting and been very slow for a couple of years. So inflation will keep going down. I think also it signals that the economic activity will start deteriorating, and we probably will see a recession next year in the United States. This cost push inflation, by the way, is another theory of inflation, but it doesn't hold water. So that's basically my reaction to that. The headline thing and the narrative kind of makes sense. It's a little bit like oil prices going up create inflation. It's another nonsensical thing. And to get a handle on that, my favorite example is to look at Japan in the 1970s. One factor in the 1970s that led to a burst in inflation, people say, is that, remember, we had two oil crises in the 1970s, one in 1973 and one in 1979. Oil prices shot up. We had the embargo, remember, in 73. And in Japan, the Bank of Japan, like many other central banks, said, well, they're going to accommodate that increase in the oil price shock by letting the money supply increase. And, of course, they had more inflation in 73. The 79 go-around, there was an oil crisis. The prices went up again in oil. But the Bank of Japan says, we're not going to play ball this time. We're not going to accommodate that by increasing the money supply. And Japan didn't have inflation. They had a relative price increase in oil, but they didn't have an overall increase of everything in the consumer price index. And the reason for that is that the Bank of Japan more or less kept the money supply controlled. So again, these are examples. You got to keep your eye on the ball. And the only reliable model for what they call national income determination is the quantity theory of money, looking at the money supply, what's happening to the quantity of money. And what is national income determination? What are you trying to do? You're trying to forecast changes that will occur in nominal GDP. Well, nominal GDP is real GDP plus plus inflation. So it has two components in it. Real economic activity, which doesn't change all that much in most cases. And the other thing is inflation, which can change quite a bit. I like to look at markets to see what the probabilities of something might be. And you can do this with Fed funds because there's a Fed funds futures market in the Chicago Mercantile Exchange. In the December meeting, by the way, the probabilities are 38% there'll be no change at all, and 62% that they'll have 25 basis point reduction. They're lost. They're not looking at the money supply, so I think they're just flying blind. So what they goosed the thing way too much when COVID hit. And by the way, COVID hit in March of 2020. By February of 2021, the money supply was growing a little over 18% year over year. And that's a record rate of growth. So they goosed it. We, of course, eventually got inflation. Now they put the thing in reverse and they've contracted the money supply, and inflation's falling like a stone. And I think we'll probably fall below the 2% target of the Fed next year. So the Fed, by not looking at the money supply and letting the money supply measured by M2, which is the broadest measure the Fed has, by not keeping that at about 6%, Hanke's golden growth rate that's consistent with the Fed's 2% inflation target, they're giving us a roller coaster ride. Up, down, up, down, up, down. That's what happened. If you don't keep the money supply growing at Hanke's golden growth rate, you're going to be all over the place. If you actually look at the amount of money people were holding relative to GDP, it's basically burned off in the summer. The excess is gone. Now we're a little below the trend rate of growth in that variable, which would be M2 divided by GDP. That's how you calculate the excess. And the excess was huge, of course, after the monetary injection, because the M2 went up. That's the numerator. It went skyrocketing, and GDP actually went down for a while. A tariff is like a sales tax on all those items that are being imported. So, as you know, if you tax something, you bring the demand for whatever it is down. People don't want to buy as much of it. So it'll slow things down. And trade is something that, unfortunately, politicians, including Trump, of course, they think trade's a zero-sum game. It isn't reality. The reality is that it's all positive. The seller has to gain, otherwise he wouldn't sell, and the buyer has to gain, otherwise he wouldn't buy. So it's just wrong-headed thinking, and it will be a dent in the economy. How big a dent will depend on what the nature of the tariffs are and so forth, but it's bad news. I think the S&P is pretty pricey right now. There are a number of things that aren't being included. Number one is what the effects of tariffs will be. That's not included. What the effects of these wars in Ukraine and the Middle East, that's not priced into the market at all. I mean, they're shooting long-range missiles now today from Ukraine into Russia. That's not priced into the market whatsoever. The third thing that isn't priced in is green transition, going green. It's going to cost an arm and a leg, not priced in, and on and on. How about just the political uncertainty? We're going to have the most important economy in the world that produces the most important currency in the world is the United States. We have a big regime change coming with a new administration, and no one knows exactly what's going to happen. I mean, even tariffs, no one knows really what Trump's going to do, because on the one hand, he gives a number and he says he's going to do this. But then a lot of his advisors say, oh, that's just a bargaining chip he's going to use with the Chinese and other people. So it might not really amount to too much. It depends on what kind of deal he cuts with them. But remember, China is not going to sit back and do nothing. And China controls the commodity markets. And this relates not only to the United States, but all the Western world big time. I mean, if you look at all the critical materials are controlled by China. And people think, oh, that means they have all the mines and deposits of these things, the rare earths. No, it's processing these things. It takes very sophisticated chemical process and make a rare earth usable for something. Even even if you're producing something like lithium, spodumene, or even hydroxide, you got to send it to China to get it processed. By the way, China has made it very clear, you punch me, fella, I'm going to punch you back. The West has a totally stupid idea about this, by the way. It's a little bit like the war in Ukraine. In the West, they complain because Russians have brought North Korean troops in. They say, oh, you can't do that. You can't get armaments from North Korea and China. That's a bad deal. You're not supposed to do that. The West, that's the way they talk. It's like a kindergarten type thing. The Russians are basically saying, buzz off. We're in a war. Why are we in the war? Because the West went over the red line. We told the West that the red line was that Ukraine would not have an entry to NATO. And in 2008, the West said they could enter NATO. And then it's just gone downhill ever since. But you have to put these things into context. That's my point. You don't just start from today, day one. The news will all be about these rockets going into Russia. But there's a bigger story. How did the whole thing start?